Cool. Hi, guys. My name is Suraj Srinivasan. I graduated from MIT studying math and CS. I'm a researcher at Jump.
I'm Alex Toberoff, graduated from Columbia last year, and I'm also a researcher at Jump. So kind of broadly, we're both on the R&D team where we focus on contributing to open source infrastructure, as well as kind of focusing on protocol design and development. And we're both kind of core contributors to Pyth, which we're going to be talking about today. So the broad agenda can be split into three parts. So the first is going over the general Pyth architecture, and then kind of what specifically in this architecture makes Pyth different and unique from sort of other oracles in the crypto. And lastly, what kind of new innovations in protocol design does this Pyth architecture allow for?
So fundamentally, we think that DeFi sort of has this demand for speed. Recently, there's been an explosion in on-chain trading. And in order to have longitudinal success, you really need a low latency oracle with accurate pricing for consumers. So Pyth is an extremely low latency oracle, which we think enables two main things. One is greater capital efficiency, and the other is that it expands the protocol design space. And we'll actually go into an example of how it does so later. So how does Pyth fundamentally work? Pyth sources data from first parties. So that is trading firms, market makers, and exchanges, and they receive their pricing information by interacting with KEX and OTC trades. This information is then published to PythNet, which Alex will discuss later. And finally, that price can actually be taken from PythNet and relate to any destination chain. So we believe that Pyth is different than existing Oracle solutions for three main reasons. The first is that Pyth leverages first-party data publishers. The second is that Pyth publishes price feeds that include confidence intervals. And finally, it includes this novel pull-based model that we'll get into. So first of all, as I discussed, Pyth sources data from over 75 different market data providers, which I'll refer to as MDPs. So these are trading firms like Jane Street or Jump. They're exchanges like Binance, Gate.io, Huobi, etc. And what that enables us to do is offer the most accurate pricing. The price information that these market data providers are sourcing are directly from the exchange, meaning that pricing on-chain is now less susceptible to front-running and is ultimately more accurate. Now, what Pyth also enables is any price feed is provided with a confidence interval as well. Now, Pyth currently supports over 190 price feeds that range across cryptos, equities, FX, and metals. And basically, these confidence intervals enable three main things. So this graph to our top left, the confidence interval that Pyth supports is robust to manipulation. So what does this mean? Basically, if we have a malicious MDP who's reporting far outside of everyone else's range, Pyth's price feed will reflect the most accurate price with the highest confidence that's robust to manipulation. The graph you see on the top right shows that Pyth's aggregate price weights data sources with different levels of accuracy. So if we have two MDPs, the ones in blue and yellow reporting with extremely high accuracy, and two others in green and red reporting with much lower accuracy, the Pyth aggregate price will more accurately reflect higher accuracy price feeds. And finally, on the graph on the bottom, we see that the aggregate confidence interval reflects the variation between publishers' prices. So since our MDPs are all around the world, we recognize that pricing is different around the world, which means that prices can often be dislocated. So the confidence interval that Pyth actually provides varies based on how confident our publishers are and are ultimately robust to manipulation. I'll turn it over to Alex to sort of show how this actually looks and discuss the pull model.
Sure. Yeah, so this is kind of a live demo of a particular price feed, basically updating on a millisecond time basis, and you can see the actual confidence band kind of getting a little smaller, then expanding as it's going. So you can look at this for any price feed on the Pyth website if you're interested. So kind of going into this kind of novel pull-based architecture for Pyth, first just to discuss how typically an oracle will work on chain. So effectively there's some aggregate price computed off chain, and then that gets pushed on chain at fixed intervals, typically basically by one whitelisted party. So obviously depending on the fixed interval, but typically this is done on the order of every kind of 10 to 20 minutes if we're talking about Ethereum. So of course that can lead to actually quite inaccurate, as well as quite inaccurate and stale data. So conversely for Pyth, it effectively is this pull-based model where Pyth operates on this separate, on effectively its own blockchain called PythNet. It then streams the prices aggregations on-chain. That then gets sent through Wormhole effectively. So once that's verified, then any entity, any person, no whitelisted entity can effectively take that verified price, submit it to the Pyth contract at any point in time. So effectively what that unlocks is that, let's say I'm a user or I'm a protocol and I'm doing something particularly latency sensitive, like pricing derivatives, for example. Then I can take the most up-to-date price, which would have been updated in perhaps in the past, like, I don't know, second or so. So there are a few kind of clear advantages of that. Of course, you can have lower latency, safer, and far more accurate pricing. So for a lending protocol, for example, it might be a little bit less sensitive to having the most up-to-date price. This can still have a large impact because you're going from a price that's up-to-date every 20 minutes to a price that might be at the max like 5 seconds stale. So we want to present a particular case study that I think is quite illustrative of the difference between the kind of typical push-based model and the pull-based model that Pyth is kind of pioneering. So before, the way synthetics typically works, this is sort of at a pretty high level, is that a user will queue a market order for some derivative on the platform. The keeper will then use the last push price to confirm the order. And effectively now it works afterwards, same kind of first step on the user. However, now the keeper, instead of referencing the last push price, which could be up to 20 minutes stale, now they will take the latest kind of on-chain price that has been verified, submit it to the Pyth contract that verifies the price, and then that's considered the new canonical price for that particular price feed. So as a user, I'm getting far better pricing for whatever derivative that I'm trading. And then on the protocol's behalf, so for synthetics, it's quite a bit safer because let's say you have it's quite a bit safer in the event of like a liquidation, for example. Like you could have over a 20-minute period, there could be quite a large kind of price dislocation between the Oracle and the actual like true price of like true centralized exchange price, which can of course present a lot of liquidation risk of the protocol. So as you can see in this diagram here, it's comparing the SEX price for Binance, Pyth, and then a competitor Oracle. As you can see, the competitor Oracle here is updating kind of on the order of like 10 to 20 minutes. And it's kind of this pretty long step function where Pyth is tracking the SEX price pretty accurately. So through this point in time, like let's say between 1420 and around 1430, that's actually a pretty big difference in price. That could potentially, let's say its large size on like a lending protocol, for example, could potentially create a lot of bad debt for the protocol itself.
Yeah, so this graph actually came from a report we did for synthetics. And what we find is that on expectation, Pyth price lags the Binance price on expectation on less than 5 seconds. And the competitive Oracle at that point, the average on expectation lag from Binance or average update time was over 200 seconds, and the price dislocation was over 20 basis points. So fundamentally, we believe that Pyth is an Oracle that stands apart due to its more robust data and lower latency price feeds, and ultimately leads to better UX, better capital efficiency, and improved protocol design space. We're happy to take any questions. Thank you. Yep.
Yeah. Are there any examples of different ways in which like lending protocols and other protocols utilize like confidence intervals and like anything like innovative you think new protocols can do to utilize that kind of extra data that you provide?
Yeah, so we think fundamentally confidence intervals can lead to more effective risk management. So for a given lending protocol, it can be the case that with a far wider confidence interval, you're much less likely to let an individual take out a much higher collateralized loan. Given that, we saw what happened in mango markets, for example, right? That sort of thing could have been mitigated with more effective risk mitigation, which is enabled by that confidence interval because that price is varying wildly on centralized exchanges.
Yeah, so let's say you're doing something you don't care too much about having, the most recent price, then whoever updated the price last, that's just stored as, like public variable in the Pyth contract on whichever chain you're using. So you don't actually have to pull it yourself. You could also, of course, like run a crank to, at some particular time step, update the price.
Yeah, so we think that bringing Pyth to StarkNet will definitely help to sort of improve the protocol design space. And, we hope to at some point integrate Pyth onto StarkNet. And yeah, we'd love to bring this protocol. All right, cool. I think we'll lend our time to the next speaker. Thank you.
Thanks a lot.